Move on to item 2. We're being asked to approve the public minutes of the subcommittee meeting held on the 17th of November 2022 as an accurate record. Can I ask if any member who does not agree with this proposal to raise their hands now? Yeah, I see no objections to the proposal to approve the minutes as an accurate record, so we will take that as carried unanimously. Thank you. Item 3, turning to the action log. Officers, do you have any comments or updates?
I'll just touch on 3 of the points. So there's 3 of the ongoing issues there. One is the passive options that we've been working on. Obviously, there's an update in the ISC today. The private equity review, again, there's an update in the ISC agenda today. Hopefully, we'll be looking to complete that soon. And then one of the other points I just wanted to mention was the property review. We'll be planning to do some work outside of ISC, hopefully remotely, in the April-June period, once we've got the strategy review that will be going to the March Pension Committee done and dusted. That's it.
Thank you for that. Members, do you have any questions on the action log? No, I see nothing. So we are asked to note the action log. I trust we're all happy to do so. Thank you. Item 4 is petitions and public questions. We've received no petitions or public questions. Okay. So move to item 5, the Cambridgeshire Pension Fund Investment Monitoring Report for the quarter ended 31st of December 2022. James Thurgood of Mercer will introduce this report. Thank you.
Thank you. So if you're in the main pack, it's page 18, or if you're just in the report itself, it's page 3. So just thought I'd start by giving a kind of brief market background and overview as to what we saw over Q4 22 and kind of over the year. So 2022 was a challenging year, let's say, for markets. We had a backdrop of the Russia-Ukraine invasion causing, felt around financial markets, rising inflation, rising interest rates, and that kind of fed through into asset class returns. So just looking at the charts, you can see that the bottom chart there, 12-month performance to 31st December, basically the only positively performing asset class was commodities, which I suppose, we all see that coming through with our energy bills, and that's kind of what's going on there. But looking kind of over a shorter period, the 3-month performance was actually relatively positive for most asset classes. So over the quarter, most major central banks continued their monetary tightening, so rising interest rates, particularly in the US and China. So the Fed in the US, they're predicting, their forecasts are showing interest rates peaking at about 5.1% over 2023. In China, we saw a kind of reversal of quite draconian COVID restrictions. So amidst protests in China, and they've reversed quite a lot of the COVID measures, which was viewed positively by markets. And then in Europe, energy price rises would continue to kind of feed through, and that was felt in inflation. And as a result, the European Central Bank increased interest rates to 2.5%. In the UK, we saw quite a significant period of gilt market volatility. So in response to the mini budget, we're calling it, you have to put inverted commas now because it wasn't such a mini budget. Basically, in response to that, the government yields from government bonds spiked to 5%, which was pretty unprecedented. What that means for the fund was actually positive, and we'll get onto that. And what it meant from a liabilities perspective is that the liabilities actually fell meaning that there was an increase in funding over the quarter. But following that kind of volatility with Liz Truss and then Rishi Sunak coming in, that was viewed positively, and there was kind of a fall in yields from there. And then on just general interest rates, the Bank of England increased interest rates over the quarter. Just pause there quickly for any questions or comments. If not, I'll move on. So just looking over the page on page 19 of the pack, or page 4 if you've just got the report, as alluded to, you can see there that the funding level has increased quite materially. There's quite a nice steady upward trajectory of the red line, and that was there was a modest increase in assets over the quarter, coupled with a decrease in the liabilities due to the increase in yields, which meant that there was positive from a funding level perspective. So I'll just move on, and kind of the thing that I wanted to finish on was on page, well, starting on page 24 or page 9 of the manager performance. If we start just looking at the equity portfolio, so the fund has 4 equity managers: Joe Hambro, Dodge & Cox, Longview, and UBS, and they're all doing different things, which you can kind of which you can see in the numbers there. And that's, you know, by design, that's how we've constructed the equity portfolio. We don't want all managers to be doing all of the same things, so they're all kind of doing slightly different things. So more specifically, you can see Joe Hambro, they were well broadly flat over the quarter and heavily down over the year. That's due to their kind of growth style. So they will invest in growth companies that they think are going to grow over the medium to long term. And then you contrast that to Dodge & Cox and Longview. They're what we would call a value manager. So they'll invest in companies that are perceived to be undervalued. So they're doing different things. So as expected, their performance has differed, but kind of in line with expectations. And then you've got the UBS passive equity, which effectively is just tracking the market and is doing and will, like I say, track the market. Moving on to the fixed income, given the environment that we had over the course of the year, that kind of also performed in line with how we would have expected with rising interest rates, the negative performance over the year. But positive to see that the Blue Bay multi-asset credit in particular did have a strong quarter. Then flicking over the page onto page 25 of the main pack, or page 10, looking at the alternative portfolios. So we've got property in there. Property struggled, had a difficult quarter and year. So you can see that on the top line, the Schroders property mandate. And I'll just touch briefly on so we've got private equity there as well. So we've got Foresight coming in today. So it'll be interesting to get an update from them on kind of how they're seeing things and how they're positioning going forward. And then briefly just on the infrastructure mandates. So there's quite a lot there, but actually overall, all of those infrastructure, so from UBS downwards, only makes up about 7.5% of the overall portfolio. So while there's quite a lot of managers there, quite a lot of wacky numbers, actually in kind of taking it as a more holistic view, kind of not really got any concerns there. So that was everything for me, unless there were any questions or comments.
Yeah, I just wanted an explanation for Schroders bonds. It's all sort of minuses.
Yeah, so that Schroders bonds allocation is kind of a buy and hold allocation to index-linked gilts, so inflation-linked government debt. And as we saw through back into September into October, as we had that mini budget gilt crisis that was kind of very technical that we touched on the last time. Long-term interest rates really spiked And when long-term interest rates really spike, the value of those bonds really fall because we're discounting those future coupons that we're expecting to get through at a higher rate. So the present value is a lot smaller, which is why you get that really strong negative performance coming through. Now, Schroders aren't actively managing that portfolio. They're just buying some bonds because they're money good assets that have inflation linkage. So it's kind of not a job, not a function of the way that Schroders have managed that mandate, a function of the market that we've found ourselves in, where the value of government bonds has fallen quite materially. So kind of really strong negative performance from the assets, but actually, when we look at that on the other side of the balance sheet, that's also had the same impact in terms of the value of the liabilities, because effectively we use a proxy to those bond prices to value the liabilities, so that their present value of those future payments are an awful lot lower because the interest rate has risen as well, which is why we're seeing that quite material drop in the liability value and the increase in funding level, because the assets have outperformed the liabilities quite materially.
It's just that the same thing's happening with them in property, and that's quite concerning.
Yeah, it's kind of it's a correlation of factors that are driving those asset returns. So the same as interest rates going up, pulling down the value of those bonds, as we kind of know from house prices and mortgage costs. Obviously, the rising interest rate environment has meant that debt and mortgages are more expensive to service. So therefore, we've seen a fall in the value of those properties as well. So again, it's no material, and our job as a monitoring piece is to back out to say, well, is it an asset class performance issue or a performance driver, or is it a manager performance relative to that market? In these cases, it's the market environment that's driving the performance of those assets as opposed to the management of the manager, which is a kind of longer term piece. So we don't have any, long short, we don't have any concerns with Schroders at the moment in terms of the big picture kind of asset allocation piece and where we allocate to managers. Some of the changes will be driven by the strategy review that we'll talk about at Pensions Committee on the 30th of March, where we kind of look at those big picture bits of, do we still want to hold that allocation to property? And we did a bit of a property review last week, but we'll look at that kind of high level property allocation, look at the bond allocation and say, is that right? And think about those big asset class decisions that are driving that performance as opposed to the managers.
Thank you. Any other comments, questions, anyone?
Yeah, just one question around Longview, because they've been performing really well. So over 1 year, they're now upper quartile, significantly above benchmark, and or 10.5% excess return. But you mentioned you badged them as value alongside Dodge & Cox, and we appointed them as we've discussed previously as quality. What's the latest in terms of do you know where they are in terms of what they look like under the hood?
Yeah, so it's a good question and something that we've been looking at in some detail, and Mark's kind of given the highlights there. So just to recap, so we appointed, there's broadly 3 different styles of equity manager that you can have. There's growth, as James talked about, really looking at companies that are going to grow profits into the future. There's value, that sort of bricks and mortar and companies that are undervalued by the market. And then there's quality, which is a little bit like value, but higher barriers to entry, have something intangible, have something, a USP effectively. And we want a mix of those different styles across the portfolio because it gives us diversification and all those good things. So when we built the initial portfolio, we had Dodge & Cox in there that was the value manager. We had J.O. Hambro that was the growth manager, and we added Longview in as that quality piece. Throughout 2020, the performance of Longview was very, very disappointed. And when we did some analysis from it and looked at what happened through that period and the way they were evolving the mandate, it looked very much like they'd evolved their process into more of a value type manager. So we've been doing some enhanced monitoring of them since then, because we don't like managers changing their style. We like to buy into an investment approach that we know and understand and fits in with the rest of our portfolio. And we don't like it changing because then we get those correlation of risk coming through. So that when one area of the market underperforms, we participate in that underperformance more. So in terms of a backward-looking style analysis, they look very much like value. That style analysis has changed to look a little bit more like quality now. But when we go in and speak to Longview, we still have difficulties understanding exactly what their investment approach is and how true to that quality mindset they are, which is why we don't rate them. We still rate them as a B rating because we think they've moved away from that. They've had personnel changes, which meant they've moved their style to something that we didn't buy into in the first place. So that's still a concern for us because it doesn't fit in with the rest of the portfolio that we want. The performance has been strong. And again, it's trying to back out how much of that is down to the manager or how much is the market environment supporting the approach. We know looking at Dodge and Cox that are absolutely a value manager because things are never siloed. Things kind of are on a quantum of where they sit on style, but Dodge and Cox are very much a value manager. So we've seen some really strong performance from Dodge and Cox versus that growth approach of JO Hambro, as value has outperformed growth, as interest and rates have risen and persistent inflation has come through the headwind to growth. So some of that value bounce back has helped Longview and been a tailwind to Longview. But you can see if we were to think of Longview, and that's an open question. If we were to put Longview in a value bucket and compare them to Dodge and Cox, they've underperformed versus Dodge and Cox, who are the true value approach. So there are still fundamental questions for us over the shape of that portfolio and the styles that we've got in there, because Longview still for us don't look like a true quality manager. In terms of where long-term performance has gone, the timing of when Cambridge went in through 2020 was unfortunate because the fund invested in 2019, so had some material underperformance on the since inception numbers coming through. That has strengthened quite a lot because we've had that tailwind from the value approach and the interest rate approach coming through, to the point where I think off the top of my head, since inception, Longview are behind benchmark by 0.5%, I think, annualized. Okay, yeah.
It's literally just changed. The latest report, it's 6.5 versus benchmark 6.5.
Yeah, so 0.4 under. So kind of there or thereabouts. Now, again, what we'll look to do as part of the strategy review is we'll agree that high level equity allocation, and then we'll go and have another look at what makes up our equity fund managers. We've done that with the passive bit, we'll do that with the active bit, and then we can have a discussion about what shape we want in there. Do we want those tilts in there? Do we want to add something in that balances the whole thing out a little bit more? So something we're looking at quite carefully, particularly on the Longview piece. We also look at other things in terms of assets under management, because that impacts the viability of the business. So we are looking at those things. But yeah, we still have it's a piece of work to look at the shape of that portfolio coming out in the start of the strategy review.
Thank you for that. Any other questions? Anyone? And thank you for taking away the question I actually had, which was I wanted to understand more of that, particularly as we've actually discussed that several times. So thank you. Okay, so we're being asked to note this report. Are we happy to do so? Thank you. In which case we move on to item 6. The following items on the agenda are exempt from the publication, so the subcommittee will need to decide whether to exclude the public and press from consideration of the following items on the grounds that the reports contain exempt information under paragraph 3 of part 1 of Schedule 12A of the Local Government Act 1972 as amended, and it would not be in the public interest for this information to be disclosed information relating to the financial or business affairs of any particular person, including the authority holding that information. May I ask if there is a general consensus in support of the recommendation so the subcommittee can take it now? Yes, thank you. As the committee has resolved to move into private session, we will now close the public part of the meeting and stop the live streaming via YouTube. Thank you very much for anyone who was watching. And the next meeting is on